All right, welcome everybody. Maddie Keegan is to my left, who most of the Frazier folks know. Brian Houtz. Julia Fuentes is with us from Vanguard. So you're not record setting, Julia, but you're getting pretty close. This must be a hot topic that makes everybody very excited. All right, let me get my share going.
What could be more exciting than Social Security?
Um, Discussing the imminent doom of Social Security. Could that be another? Welcome to the Social Security webinar. We're going to start off with a little trivia. Julia has received absolutely no prompting on this, but this is a quiz, Julia. Can you tell us more than one person in this photo?
No.
Can you, can you tell us one person in this photo?
So they're they're obviously signing into legislation, Social Security.
Yeah, FDR. Social Security turns 90 this year. We thought that was a fun factoid. Sorry to put you on the spot, Julia. I put Maddie on the spot yesterday, but
I also did not get two, so
yeah.
Yeah.
Uh, So that's the topic of the day. Just a very brief commercial here for Vanguard. Julia works for Vanguard. All of our clients own Vanguard funds and ETFs. They're a very unique investment manager. They run as a mutual company. That's very rare in our industry. So if people buy more Vanguard, Vanguard gets larger, Vanguard gets less expensive, Vanguard passes that on to their fund owners or stakeholders. So that's a very unique structure. There's a little commercial here on screen. If any of our clients want to talk more about Vanguard, we can give you some highlights on why they're a big partner of ours. Maddie, I'll let you introduce Julia.
great. We are very excited to have Julia. So as mentioned, she works with Vanguard. She's been there 18 years. She currently serves as the Vanguard's financial planning and coaching strategist, and has years before that in the industry as well. She earned her Bachelor of Science in Finance and Marketing from Bloomsburg University. She also has her Certified Investment Management Analyst certification and Wealth Management Specialist. So lots of knowledge and experience, and we're very excited to hear from her on Social Security.
Julia, I'll drop my share and then you're up whenever you're ready.
Great. So you're okay with me screen sharing?
Please.
Perfect. Thank you. So we are going to jump into understanding Social Security, where we're at today, where this can evolve to, and we're going to touch on the most common questions that we get on, hey, what are dependent benefits? Do I qualify? What happens if I pass away? What happens to my Social Security benefit? And then we'll touch on some special considerations, such as the taxation of your Social Security benefits. So to jump right in, Social Security has been through a long road. It was first incepted back in 1935. And we've been through a lot of changes. They actually used to pay Social Security as a lump sum in your final years at age 65. So we obviously had to evolve from there. But the last time we had a major overhaul of the system was in 1983 under the Reagan administration. That's where I still remember all the talks back in the 80s, the talks, oh, I'm not going to get Social Security, it's going away. And it's kind of funny, as a younger child hearing that back then, I'm like, I don't know what they're talking about, but everybody's concerned. And then today it's the same conversation we're having because we're sitting in a similar place that we were back in the 80s. So back in the 80s, they had some fear that, hey, looking out into the future, we're not going to be able to fund all of the Social Security benefits. There's less people paying in and a lot of people drawing out. We need to do something. So that's actually when they introduced the taxation of Social Security benefits. But as of right now, with Social Security and the trust funds that they have out there, we have payroll taxes people are paying that we're going to dig into a little deeper. They have the tax that some Americans pay on their Social Security benefits that goes into the pot, and they have it very conservatively invested in government securities, and those are our current revenue sources. As of June, so a couple weeks back, every year they publish the Social Security trust funds. When are those trust funds going to run out of money? And the most recent projections, they have us at 2032 before they say there won't be any more money in those trust funds. So what does that mean? Does that mean nobody gets a Social Security benefit? What that means is if we don't pass any legislation, we don't touch the system at all Americans across the board, you're poor, you're rich, everybody could face around a 20% benefit reduction. This is something that our politicians all actually agree on. We don't want Social Security to fail under our watch. But also keep in mind Congress is deadline based. This deadline is more than 5 years into the future. So they're not rushing to do something today. 5 years to Congress is like 100 years to us. But we can start to see they're probably going to form some committees in the coming years. And we're going to start to hear these reform items that we're going to talk about today get thrown around. They're going to start debating them, because that's what they're going to have to agree on, is what are we going to have to do to solve this math equation and close that 20% gap. So it's really important to understand Social Security basics and the primary funding lever of Social Security. So come 2032, about 80% of our Social Security benefits are funded through payroll taxes. So if you are working and you have a paycheck, you pull that out, you're going to see a line item, OASDI, Old Age Survivors Disability Insurance. This is what you pay into Social Security. 6.2% from the employer, 6.2% from you as the employee, until you hit a max wage base. So they set this every year, it gets indexed up with inflation, but as of 2026, once you make $184,500, you don't pay in that 6.2% anymore. You get a paycheck increase. You'll notice for Medicare, high earners pay in more. We don't have a max wage base. They call the combination of these two taxes FICA taxes, and they call these wages your FICA wages. Well, reform items on the table. That 6.2%, we can make that number whatever we want. So back in the 80s, we paid 5.4%, and they increased it to 6.2%. So that's a lever. Hey, just pull a tax lever. We know politicians don't like to raise taxes, but it's an easy way to fund this gap versus letting everybody face a 20% reduction. The other thing they could do, this max wage base, $184,500, they could uncap it. They could say you make $1 million, you pay Social Security tax on the full million. They could do a tiered approach and say, okay, we're going to still have a max wage base, but once your income is over $400,000, we're going to tax you on the wages above that amount. Maybe they make that 3%. So lots of variations they could do with this max wage base. So at the end of the day, I always scratch my head and I say, are they going to let everybody's benefits get cut? Or at the nth hour, are they going to pull a tax lever to keep this going? I don't know. This is only one of many, many reform items they have to solve this math equation. So to qualify for Social Security, you pay into the system for 10 years. So they do work in a credit system, but for most of us, pay in for 10 years, you qualify for a benefit. They're going to base your benefit on your 35 highest earnings years. Again, you don't have to work 35 years, you only have to work 10. If you work less than 35 years, they're just going to throw some zeros in for your earnings for those years you didn't pay into the system, which can bring down your average on which they're going to base your monthly benefits on. So what we're showing here is That person that hit the max wage base for 35 years, so you were a high earner, you hit it for 35 years, what the max benefit payout is at different claiming ages for that high earner. And then this will adjust each year and get inflation adjusted up. So to throw out another reform item, the 35 years you're looking at here, there's a reform item saying, let's make this 38 years. There's not a lot of people that have worked 38 years. We could throw another couple zeros on the record and maybe it'll bring their average down ever so slightly and we pay everybody just a little bit less. They won't even notice, but spread across millions, we could get some solvency there. Now, it's very important to understand these two terms, full retirement age, primary insurance amount, because it's what everything is based off of. So I want you to find your year of birth in this chart, and it's going to correspond with the retirement age the government has chosen for you. So if you were born in 1962, your full retirement age is 67. If you wait until age 67 to turn on your benefit, you're going to get what is called your primary insurance amount. Something to keep in mind for our younger folks. Let's say you're 50 years old. When you get and you look at your Social Security statement, it's going to give you a number. They are assuming that you are continuing to work and make what you made in FICA wages last year. You're going to make that all the way up until your full retirement age. If you decided, hey, I'm going to retire, you can zero out your earnings on SSA.gov. Moving forward, it will adjust that so you get a real finer tuned number. So they do have some assumptions, assuming you're going to work up until this age. Now, reform item on the table, which all of us have heard, this does swirl around in the news, raise the full retirement age. This is something that the Reagan reforms did. And to be honest, I was a kid at the time and I didn't notice. I'm like, oh, my full retirement age is 67. Of course. This is something we could face again, that they will gradually tick up the full retirement age to age 68, age 69. That will affect more of our younger Americans. My definition of younger Americans changes with every decade. So younger Americans, people in their 50s and below. If you're at the goal line, you're in your 60s, this shouldn't affect you, but something that is higher up on the list of reforms. Let's stretch this out a little bit longer. People are living longer. Now, we all know back in the 90s, when you made $40,000, that's worth a lot more in today's dollars. So they are giving you credit for wage inflation. Then once you turn age 62, you are going to get the cost of living adjustments that they announce each year, regardless of if you turned your benefit on or not. So a lot of people in 2023, when we had a really high COLA adjustment, they're like, wow, I'm going to quick turn on my benefit, lock this in. You are going to get that if you are 62 or older. They will factor it into your primary insurance amount moving forward. So a couple reform items. There's a lot, but I'm going to mention a couple here. There are talks on, hey, we're giving too much credit for wage inflation. Maybe we should tie that to a different index. Give credit for a little bit less. They have had discussions about means testing cost of living increases. So we're going to look at your tax return and see what the income is hitting your tax return. And if your income's high, let's say more than $150,000, you won't get the cost of living increase moving forward. Kind of similar to Medicare. The more income showing on your tax return, you're going to pay more for Medicare. They could do something similar with Social Security, potentially not give you the COLA adjustments if you are high income. And I'm not saying one's going to happen over the other, but we can expect a variation of these reform items to solve this math equation. They might do 4 to 5, probably not just one. So I'm just giving you a flavor of some of the hundreds of reform items on the table. So our last step, we have your 35 highest earnings years. We've indexed that up for inflation. We've broken it down to a monthly number that they call AIM, your averaged indexed monthly earnings. The first tier, they call these bend points, you're going to get 90% income replacement. Second tier, 32%. Final tier, 15%. The good news is you will never have to calculate this. But this exists because we want to give more income replacement to a low earner relative to a high earner. So a couple reform items on the table. Hey, this 15% bend point, let's make that 5%. So for our high earners already claiming Social Security, if they did that, this could adjust your monthly Social Security benefit. I question if they're going to do something that's going to touch people already claiming Social Security, just because that's our largest voting demographic. We don't want to make people on Social Security mad. So another thing they could do is they could add another bend point and make that additional bend point 5%. So if they uncapped the max wage base, they could couple it with this, tax you more, limit what we get out of the system. So lots of different options for what they can do to solve that 20% math equation. So you can start taking your benefits as early as age 62. So you turn it on at age 62, that is you turning on your benefit early. You are not full retirement age, so you can face up to a 30% benefit reduction. Some people that really need this money as part of their budget, they can't retire without it, they might turn it on. People that have health conditions, they say, wow, I don't have longevity. That is a factor that plays into this. And also, this is not the same answer for everyone. I know I think it was last year, Dave Ramsey went on a podcast, said everybody should turn on at age 62. Turn it on, invest the money, everyone do it. A blanket statement, because he didn't have time in his short little snip to give every if this, then that. You need to sit down with your financial advisor to figure out what's suitable for your situation. They can do a break-even analysis to say, hey, this is what will make sense if you live until this age. Sometimes they might say it makes sense to turn on at age 62 because if you turn on at 62, you're kickstarting dependent benefits. They're going to map out your goals to say, what are you trying to achieve here? Are you trying to not spend your investment portfolio? And that's why you're willing to lock in a permanent reduction at age 62. Because for every single month that you can wait past age 62, your benefits will continue to grow. A lot of people think, oh, I have to wait an entire year. It goes month by month that they give you credit. So these two charts are saying the exact same thing. Hey, at age 62, let's assume your full retirement age is 67 years old and your benefit amount is $3,000. You take at age 62, you only get to keep 70% of that. That 70% equates to $2,100. And you'll notice they sweeten the pot as you get closer to full retirement age. Once you are full retirement age, you don't face a benefit reduction at all. Then they sweeten the pot a little bit more. For every single year that passes, you will get an 8% bump for each year up until age 70. They call these delayed retirement credits. So at age 70, your benefits cap out. So we're going to turn your benefits on at age 70. But keep in mind, not only are you getting the 8% bump each year, you also are getting the cost of living increases that are applied to your primary insurance amount each year. So that can really pack the punch for people that have longevity. I do want to mention, because I find this very confusing, once you turn full retirement age, this unlocks your ability to do a retroactive claiming strategy. So let's say you decided I'm waiting until age 70 and you go online to apply for benefits. It's going to ask you, do you want your benefits to start 6 months ago? You're like, oh, I can have my benefits start 6 months ago. That's pretty cool. Or you sit down with Social Security and they'll say, hey, do you want me to send you a check for 20-some thousand dollars and this is your benefit amount? Or do you want us not to send you the check and you're going to have a higher monthly benefit amount? So just be prepared. Sometimes they market this retroactive claiming strategy. If you go back in time 6 months, you lock in your lower benefit amount and they will pay you for the last 6 months that you didn't get those benefits. So just something to flag because it can get a little bit confusing when you're older than full retirement age and applying online. They say, do you want your benefits to start in the future or in the past? Some people, they're turning age 70 at the end of the year. They don't want the taxable income on their tax return for that tax year for some reason. They might use the retroactive claiming strategy just to throw those dollars to the next tax year. So talk to your financial advisor if you're in one of those situations. So you might be thinking, well, I just don't trust the government. I want to do a money grab. I'm turning on at 62. I don't care. I don't need the money. Well, there's something that you really need to be aware of if you are still working. So they have chosen your retirement age and they say, hey, we chose 67 as your retirement age. And if you decide to work past that retirement age, we're going to let you take Social Security and work. We're not going to give you any problems. So once you're full retirement age, continue to work as much as you want and turn on Social Security. There's going to be no problem. So my father, he will continue to work for a very long time. He's in his 70s and he really enjoys what he does. So every year he's banking earnings into his Social Security record, and that can knock off a lower earnings year from 35 years ago. So you can actually see your benefit recalculate each year. Since he's older than full retirement age, no issue. But now let's say you're 62. They're going to say you're 62 years old, Social Security is a retirement benefit, and you are not retired. We consider you're retired once you stop employment or you reach your full retirement age. We're going to put a limit on how much you can earn before we start to withhold benefits. So the bar is pretty low. In 2026, you can make $24,480 before they start withholding $1 for every $2 above the limit. They give you a little bit more in the year you turn full retirement age. And once you're full retirement age, you're good to go. They are only counting your employment. So think of it as I am paying that 6.2% Social Security tax on this income. So you get a W-2, you're a 1099 contract worker, you have self-employment income, you have a little side business. Nothing to do with your investments, your pensions, any of that. It's purely employment that you're paying the Social Security tax. So since this is confusing, I'll run through an example because it does get a little wonky with how they do this. So let's say your friend Joanne, she's a realtor, and she's just really tired of working off of commissions. She's turning 62. She can turn on a $2,000 benefit amount from Social Security. Yes, it's reduced, but it's a sizable amount. And she says, I'm fine with that. I just want a stable monthly check. And she decides she's going to pick up a part-time gig and she's going to make $47,000 in 2026. When she goes to file for Social Security benefits, they're going to say, Joanne, estimate what you're going to make in 2026 in employment earnings. She puts a number in there. They're going to trust that number. They're going to withhold based on that number, and then they're going to reconcile at the end of the year. And if you underestimated, they're going to claw back some of your benefits. So Joanne, she doesn't think $47,000 is that much, but she's over the limit by $22,520. They're going to withhold $1 for every $2 above the limit, meaning they're going to withhold $11,260. Now, what they do is they say, this is the amount we're withholding. We're going to divide by your benefit check, and we're not going to send you a check at all. Joanne, who's filing for Social Security expecting a monthly check, doesn't get her first check until July. So if you were to tell me, hey, I make $300,000 through my employer, I get that W-2, and I'm going to turn on Social Security at 62, they're not going to send you a check all year. You'll just have to file paperwork and you're not going to get a check. So sometimes this forces our hand. If we are not retiring, our only option, depending on our income, is going to be when we turn full retirement age. But also, this is not a huge deal. Once you turn full retirement age, they're going to count up all the checks they didn't send to you. Okay, Joanne, we didn't send you 2 full years of checks between 62 and your full retirement age. We are going to recalculate your monthly benefit as if you filed at 64 instead of age 62. So they don't pay you back in a lump sum, but as long as you don't pass away, you will get a higher annuity payment moving forward. So some people, they turn on Social Security because they're retired and then they get bored, they go back to work. Not a huge deal. Yeah, they're not going to send you the checks, but you'll get a higher benefit once you turn full retirement age. So not the end of the world, but something to be aware of so you're not surprised when your checks start getting withheld. Now, lifespan really plays into this. If you could tell me the day you are going to pass away, we could tell you the absolute optimal Social Security claiming strategy. So don't be alarmed when your financial advisor might ask and poke around, so how's your family health history? When did your parents pass away? They're asking these questions because in these optimization tools that advisors have, they have to put a life expectancy because it all really matters. If you're going to live until 100, it's going to make probably more of a case for you to wait a little longer. But if you're going to die in your 70s, well, maybe you should take a little earlier. So there's lots of different scenario analysis that your advisor can do to say, if this, then that, with the most common scenario analysis being break-even ages. This is all customized to your specific numbers, but to use an example here, we have someone that can turn on their benefit, get $3,000 at age 67. They can turn it on at age 62 and get $2,100 a month. That's a $25,200 annual income. It seems like a lot to give up versus waiting another 5 years until 67. So your advisor can tell you, okay, how long would you have to live before this breaks even? And every check after that is profitable for you waiting. And in this specific scenario, do I take it 62? Do I wait until 67? You would have to live past 78 and 7 months to start to see the profits. And break even depends on what we're looking at. 67 versus 70, hey, you would have to live to 82 and 5 months to break even, and then every check past that would be profit. So for anybody that wants to nerd out on this with your own unique situation, your advisor can run all of these scenarios to give you better inputs to your decision. So I can take a pause there, and Brian, see if we have anything, if you wanted me to pause and answer any questions before we go into dependent benefits.
That's great, Julia. We'll just make a note on housekeeping. There is a Q&A section in Zoom. So we have some people on the phone, but if you're in a Zoom portal or if you're coming in through a browser, you can type in Q&A. Julia, I didn't mention this to you. We did get 6 or 8 questions ahead of the webinar through registration. So we'll watch those. And if they're not addressed, we'll get those to you later. We did have a great question come in, so it's a good moment to pause. I don't know the answer. Maddie might. If someone had these retroactive payments that you just discussed, does that retroactively incur IRMA? And then you could also maybe do a 2-bit commercial on IRMA too. I know we might be advancing you from some slides that are later in the deck.
Yes, so if you do that retroactive claiming strategy, they are going to give you those benefits in the tax year that you're getting the money. So it could affect so IRMA basically is, hey, the money that's hitting your tax return, your AGI plus your muni bond interest, that's going to affect how much you're going to pay for your Medicare premiums. So if you do that retroactive claiming strategy and you get an extra $20,000 hitting your tax return in 2026, and that throws you over a threshold, that could affect your 2028 Medicare premium. So for Medicare, they have a 2-year look back. Your 2026 Medicare premium is based on your 2024 tax return. So depending on your situation, where your income falls, they're not going to go and say, oh, we're going to apply it now. They're just going to use it for the future Medicare premiums in that equation. And keep in mind, we're going to talk about this in a bit. For many people, up to 85% of that Social Security is taxable, and that's what's going to hit the pot for determining your Medicare premiums.
That's a good niche question. I'll just make a comment for our clients that are on the call here. You know, a ton of rules around Social Security apply to everyone. That's 300 and some million Americans. You want to think about the people that are on this call. If you make just $100,000 a year, which is a pretty approachable income these days, you're in the top 20% of earning Americans. So you don't have to have a huge income to really be in the top end of the income range. And so, Julia, IRMA comes up a ton. Tons of our clients end up paying IRMA at least a year or two. So you'll make lots of friends when we get to that slide.
Yes. So when it comes to Social Security, they're very generous with saying, hey, we understand there's a lot of people that were stay-at-home house parents and they worked harder than any of us. They deserve a Social Security benefit, even though they didn't pay into the system. So what they say is, we're going to look at your primary insurance amount, and we're going to say half of your primary insurance amount could be available for your eligible dependents. We are going to dig into this one a little bit deeper because this is the most common. Your spouse that doesn't have their own earnings record, or they have a low earnings record. Now, if you have a child that has not graduated high school yet, they're under age 19, they will be considered a dependent. So I recently had somebody 70 years old. He married somebody that was 35 years old, and they had 2 children. So when you think about it, the 2 children were dependents. They were 5 and 6 years old. They both are eligible for a dependent benefit. And then his spouse, who's 35 years old, doesn't qualify for Social Security. She's not working. She's staying at home with the kids. She's a spouse caring for those children under 16. All 3 of them would qualify for a dependent benefit. In addition to that, if you have a disabled adult child or a dependent parent that lives with you, they're reliant on you, they also could be eligible. But the government also says, you know, we do have some solvency problems here. We are going to put a max benefit that you can get off of one person's earnings record. So when you look at your Social Security statement, it's going to say family maximum benefit. And they're going to say, okay, for this scenario, $5,290 is the most you can get off of John Doe's record that he paid in. John Doe gets $3,000. That's his primary insurance amount. Let's back that out. Now there's $2,290 remaining for the eligible dependents. So now we have the 2 dependent children, the spouse that's caring for them. What they're going to do is they're going to take the remainder and split it between the 3. Now, one of these children graduates high school. They're no longer eligible. What they'll do is they'll bump up the other two people's benefits. So they do adjust over time so you can get that family maximum benefit. We don't have to worry about family maximum benefits if only one person, one dependent is claiming on your record. You fall into it more when you have multiple, 3+. That's where we start to see it. Oftentimes, sometimes it's even like two people claiming, you might hit it. So the most common dependent benefit is a spousal benefit. So the bar is pretty low. You only have to be married a year and you have to be 62 years old. And that lower earning spouse who didn't pay into Social Security at all, or maybe they have just a low earnings record, they can get up to half of the high earner's primary insurance amount. So I want to stress that it's not half of your age 70 benefit, it's half of your primary insurance amount. Now, the rule change, this happened in 2015, is they put in a rule that said high earner has to have turned on their benefit for you as the lower earner to get the spousal benefit. So if your spouse is waiting until 70, unfortunately, you can't get the spousal benefit until they turn theirs on. That is a rule change. If you're talking to people born before 1954, they had old rules. They could do fancy claiming strategies. The rules here are what is applicable this year and beyond. So the other thing I want to mention, if you are only 62 as the low earner and you say, oh, I'm going to get half of my spouse's, I'm going to turn mine on today, you are not full retirement age. You will face a reduction. And the reduction grids are even worse when it comes to spousal benefits. We'll take a look at them. So if you want to find out, do I qualify for a spousal benefit? We want to look at the high earner. What is their primary insurance amount? Cut that in half. And then we're going to look at your own benefit. You're the low earner. What is your primary insurance amount? When you do the math, if there is a leftover, you do qualify for a spousal benefit, and they're going to say, we're going to pay your own benefit first, and we're going to top it off with the spousal benefit. And the reason why I'm going over that is they call this deemed filing. When you turn on your benefits, you are filing for all benefits that are due to you now and in the future. So these are the different reduction grids, and everybody, we can give a copy of this presentation. So you'll have this if anybody's an engineer and wants to nerd out on their own situation. For your retirement benefit, we looked at this earlier. You turn on your retirement benefit, they're going to reduce it. If you are duly entitled, meaning you paid into Social Security on your own employment record for 10 years, and you qualify for a spousal benefit, you are duly entitled. If you didn't pay into Social Security for 10 years, let's say you're a stay-at-home parent, you will be considered not duly entitled, and there are reduction grids. If you take at 62, instead of getting 50% of your spouse's primary insurance amount, you get 32.5%. What I see very commonly is somebody has a low earning record, and what they'll do is you turn on at age 62. They first adjust your own retirement benefit, and then they look at your spousal portion of your benefit and reduce that and add that together. Since this is clear as mud, I'm going to walk through an example because you're going to feel like you're in a college course today. I feel like I'm doing college accounting. So William and Kate, both 62 years old, both have a full retirement age of 67. William, if he waited until 67, he would get $2,000. Kate worked part-time. She qualifies for $500. When you do the math, you say half of William's is 1,000. That's more than Kate's 500. She qualifies for a spousal benefit. So now William says, I'm turning mine on at 62. I'm going to get my $1,400 payment because Kate won't let me golf and I need to fund my greens fees. So now that William turned his on, Kate qualifies for the spousal benefit. But Kate makes her own decisions. She can turn on her benefit at 62 and get a reduced spousal benefit of 675, where Social Security is going to say, okay, Kate, your benefit, we're going to reduce that. You get to keep 70% of it. For the spousal portion that you're eligible for, which is $500 if you were 67, we're going to pay you 65% of that. And they add them together. Kate can decide, I'm just going to wait until 67. I'm going to turn on my $1,000, get the full amount. There's no reason to wait until age 70 if spousal benefits are what you are going to get, because there's no delayed retirement credits on spousal benefits. That 1,000 is still 1,000 at age 70. So in the case of William and Kate, let's flip the scenario and say William's waiting until 70. He wants the higher benefit amount. Kate can't get spousal benefits, but what can Kate get? She can turn on her own benefit. So at age 67, she decides, I don't want to face any reductions. I'm going to turn mine on at age 67, collect my $500 for 3 years while I wait for William. Once William turns his on, she will see a step up to the $1,000. When you apply for Social Security, they're going to ask you about your spouse. Once you fill out that information, it links your records, so this step up should happen automatically. So the reason why a lot of people wait until 70 is really because of survivor benefits. So at the end of the day, we hope everybody lives a very long life. You don't pass away until you're past age 100. But when somebody passes away, you only get to keep one Social Security benefit. A lot of people think, oh, I'm going to get my benefit and a survivor benefit. No, you get one benefit, the higher of the two. So what I see with a lot of people, the high earner says, you know what, Kate, I'm going to wait until age 70. I'm going to lock in the survivor benefit for the last man standing. We don't know who it's going to be, but if I pass away, at least you're going to get this higher income. So to get a survivor benefit as a surviving spouse, as long as the person that died paid into the system for 10 years and you were married to them for 9 months, so it's not a really long time, 9 months marriage, if the surviving spouse is 60 years old, they can qualify to turn on a survivor benefit. But of course, when it comes to survivor benefits, they have a reduction grid if you are not full retirement age. And this bothers me. It's very close, but they have a different grid for survivor benefits, full retirement age. But if you were born 1962 or later, it's going to be 67 for both, which makes it easy. It's just people before that, because we can't align the two grids. So if you're age 60, you only get to keep 71.5% of the survivor benefit. And the people we talked about before, the other dependents, also can get up to 75% of the primary insurance amount. We see this often with, hey, somebody dies too young and they still have children that haven't graduated high school. They will get some survivor benefits that then will turn off when they graduate high school. And also the earnings test we talked about applies. So unfortunately, my uncle passed away, cardiac arrest, 58 years old. My aunt was also 58 years old, and she was swirling like, oh my gosh, how does this even work? Well, her question was, so he was 58. He wasn't eligible to turn on his Social Security benefit. What is the survivor benefit? So he gets 100% of the primary insurance amount as the survivor benefit. So let's pretend he lived until 67. That's going to be the amount for her. Let's say he had passed away at 69 years old and he had been getting that 8% delayed credits. He was going to wait until 70. Well, that higher amount they lock in as the survivor benefit. If he had made it until age 62 and he had turned on his benefit, they have something called the widow's limit, that they say 82.5% of your primary insurance amount is going to be the survivor benefits. You could actually get a slight step up, and they're never going to short you, of course. So this is one of the primary considerations when we're thinking about Social Security claiming. We want to think about our benefits with our spouse. And then I hope nobody has to deal with this, but it happens. There is the opportunity, if you lose a spouse too young, like my uncle, you are able to make a one-time switch from your own retirement benefit to the survivor benefit, or you can start with the survivor benefit and make a one-time switch to your own retirement benefit. So it gets pretty, this is something your advisor will help you and tell you the claiming strategy. Social Security's order takers. So you have to kind of tell them what you want. Your advisor will handhold you through this because it's very, very important to get this right. So Sally and Tom, who have a very similar earnings record, unfortunately, Tom dies. Sally's turning 60 and she's retired. She doesn't have to worry about the earnings test. To fully optimize her situation, she's going to turn on at age 60 the reduced survivor benefit. So she's going to get $2,145 for 10 years. She's going to allow her $2,800 to grow by the 8% a year up until age 70. And then she's going to flip over, make that one-time switch to her own benefit moving forward. People leave so much money on the table, not understanding that you can do this. And it's very situational on what both of your benefits are. Your advisor will help you with this. So to run through a couple special considerations, you might be thinking, well, I'm divorced. How does this all work? As long as you did not get remarried and you are 62 years or older and you hit 10 years of marriage, you'll have to show a divorce decree to prove that you were married for 10 years. You can claim on your ex-spouse. If your ex-spouse is still alive and half of their primary insurance amount is more than yours, you can get the spousal benefit. They won't even know you're claiming on them. As long as you've been divorced 2 years, then they don't have to turn on their benefit for you to get that. The government knows some people are salty and will never turn on their benefit, so they put a special rule in here. If your ex-spouse passed away, the survivor benefits we just talked about, you are eligible for that as long as you hit that 10 years of marriage, even if your ex is remarried and someone else is getting the survivor benefit. You are in separate families, you both can get it. So if you're divorced, you want to talk to your financial advisor, give them that information so they're not missing anything. If you are a teacher, a police officer, a government worker, in the past, your pension from that employment hurt you when it came to Social Security. This has all been repealed. Your pension no longer matters. So let's say you're a teacher, you never paid into Social Security because you have a pension where they didn't require you to pay in. You now have the opportunity to turn on a spousal benefit based on your spouse's earnings record. You weren't able to do this prior to 2025. This was the most recent Social Security legislation, but it affects a small subset of people. I'm married to a police officer, so it affects him in a positive way. A lot of people that didn't get the memo want to look into this, talk to your advisor because you could turn on some additional cash flow. What is applicable to all of us is the taxation of Social Security. So for many of us, they haven't inflation adjusted these bands since the 80s when it was first put into play. But with Social Security, let's say you're married, they're going to say, is your provisional income more than $44,000? Provisional income is all of your income sources. line 11 of your 1040, your AGI, plus line 2A, your muni bond interest, any excluded foreign income, and half of your Social Security benefit. Is that number more than 44,000? For many people, the answer is yes. And they will say, if the answer is yes, up to 85% of your Social Security benefits are taxable. The good news is 15% is tax-free. You might be questioning and saying, but I saw something where Social Security sent us a letter and I thought it said Social Security isn't taxable. It was a bit skewed when the One Big Beautiful Bill passed. They put in a temporary tax provision, tax years 2025 through 2028. If you are 65 or older, not tied to Social Security, 65 or older, and you're a single filer that you can keep your income under 75,000, you're a married filer, you can keep your income under 150,000, you qualify for something they call the senior deduction, a $6,000 tax deduction per eligible person that is meant as a way to offset the tax bill many people face with Social Security. It's only temporary. So Social Security taxation has not changed, and it can get rather complex. Your advisor can work with you on strategies to see if you could lessen your tax bill on Social Security by doing strategies such as QCDs, qualified charitable distributions, instead of gifting cash to charities. So there's a couple different levers they can work with you on the taxation of your benefits. You may not have an option, but they can look into it. Now, to bring this all together, we threw a lot of information at you today. We want to sit down with our advisor. This is a really important permanent decision. We want to think about our longevity. We want to think about our health. We want to map out what are our spending needs in retirement. This is going to be our guaranteed bucket. We want to make this decision alongside our spouse. We want to figure out, how is this going to affect my tax situation? Am I going to continue to work and the earnings test is going to apply to me? And we want to map out our goals. What are we using this money for? Because your advisor will help you make a really educated, informed decision. Now, if you already turned on Social Security and you've been getting more than a year of Social Security payments, once you turn full retirement age, you have the opportunity to suspend your benefit. Get the 8% a year up until age 70, turn it back on. I see people do this when they turned on their benefits at 62 and then ended up going back to work and they didn't really need the money anymore. It gives you an option. You'll never be where you could have been, but you could get a little bit more. If you have been taking benefits less than a year, my father-in-law, he got laid off in his 60s, so he turned on Social Security. Then his employer called him back within a couple months and said, oops, sorry, we made a mistake. We want to hire you back. So he paid back all his Social Security benefits, got a full redo. And then we talked about the retroactive claiming strategy. That's also for people with the spousal benefits we talked about. I see a lot of people go, oh my gosh, my spouse was waiting till 70 when I turned mine on. Now we realize that's not the right thing to do. We should have turned theirs on at full retirement age. You can easily do the retroactive claiming strategy, get that money. So go and create your profile. If you haven't done it, you're going to have to do it at some point because this is how you can apply online for Social Security and Medicare. They have calculators, statements on there. And we would say give it 4 months before you want your checks to start the application process. Sometimes it can be slow. So we want to get that process started early. This is the base of your retirement income strategy. It's an important decision, and you're going to want to continue to revisit your retirement income strategy with your advisor moving forward. So I know this was a ton of information. I can throw this to Brian and see if we have any questions.
That's great, Julia. A reminder for everybody who's on Zoom, either on a Zoom app or on a browser, you've got a Q&A little portal or chat box at the bottom of your screen. So you're welcome to hop in there, throw out some questions. We did get a good question here. So, do RSUs paid out after retirement count as earned income for the earnings test when receiving Social Security?
So it depends on how they process that. For a lot of times you are going to pay the because they consider it like income. So that if it's processed and you're paying that 6.2% Social Security tax, that can count. I've seen like deferred comp get treated different ways. Some people got deferred comp and they didn't pay the 6.2% the way it was structured. So it all has to do with like, are you paying the tax on that? I don't know, Brian, if you've seen any situation with RSUs and how it's treated. Most of the time, I feel like it's treated as like, FICA wages.
Yeah, we have a lot of clients with RSUs. We also see retiree W-2s done incorrectly more than anyone would probably believe. So we'll say the final answer on that one is ask your financial advisor. We'll be self-serving with our answer.
Yeah, I was just looking to see like, hey, percentage wise, are more people? And of course, I was just looking it up and it's like, it could be either way. So, yeah, it's nuanced. It's like, yeah, it's like I think in a lot of cases it's still reported as W-2 wages. But sometimes, how they process it after you retire, it might not count. So it's very situational. Great question, though.
Julia, what about calculators? If people want to go play with this on their own, you mentioned, the engineering stereotype that wants to nerd out. Is SSA the best resource? I do know Vanguard website has some things. They might be behind advisor login walls. What would you recommend?
So SSA.gov has a lot of calculators on there. They have like a detailed calculator too, where you can really nerd out, but it requires a download. So they have some pretty good stuff. And I know you probably have something, Brian. And Brian, you have access to the Vanguard calculators that that you can run like optimization reports. But there's options through SSA or through you, obviously.
We do have lots of tools. Most of our clients have seen retirement income projections. So yeah, certainly anybody who's a client of ours, call us. We can get a lot of detail to you. I got a couple questions that came in around, I'm this age, my wife is this age, when can I file? So we'll take those offline and reach out to anybody who sent them and have a one-on-one conversation. Julia, we really appreciate your time. This is a phenomenal resource from Vanguard. Really appreciate your time and expertise to share here with our group. As a reminder, there will be a replay. We got to run these things through a quick compliance check. So within a week to 10 days, we'll have this all on YouTube. Anybody who registered will get an email with that link, or you can certainly just Google the Frazier Financial YouTube. And Julia, hopefully we'll run into you in the future. Can't say thanks enough for your time today.
Thank you so much. Have a great one.
You too.
Thanks, everybody. We'll see you soon.
Thank you.